some people can reduce up to 80, 90% of their taxation, of their tax liability from that. How does that work? How does that really minimize those tax burdens?
So it's actually 80 to 95%. And to believe it or not, even though that's high, that's conservative. Okay. I mean, I can tell you, I have one of my colleagues, my business partner, and that she has a good friend, just got the trust a couple of years ago, has a cleaning business, and her net profit, thank you, $600,000. She paid $300 in taxes. Now that's a 99.999%. Now, that's, so if somebody actually uses this to their advantage, it can be more. Now, I rather underpromise and overdeliver, even though 80% is still high, right? I think people would be happy with 40 to 60%. But I'm just saying, if you take advantage and learn this with this and work with the CPAs, the tax attorneys, accountants and stuff, you're going to be heavily surprised, right? And in turn, guess what? That's money. I can kind of go through a quick presentation if you want. Let me ask you, what other questions do you have? Because I think going through it a little might give you some.
It's well, I was going to go into if you're able to kind of like, let's say I'm a 12-year-old and you have to explain to me how that person went from $600,000 to $300. Like, how does that happen? How do you go from point A to point B? Obviously, everybody's different, but if I can understand, like in the simplest terms possible, how did she do it? Well, it could help me figure out what could happen to me. So can you go into that?
Right. I will give you this. I already told you I was an educator, guys. Right. And the thing is, I keep things simple. And so now I taught elementary. So I taught second grade and fifth grade, and I have my administration degree. So and this is a work in progress, so it doesn't have all the features that I want. So, but I'm in the process of refining it to make things simple, right? Yeah. It's all about keeping things simple, because the more complex it is, people throw their hands up, right? Okay. Yeah. So, all right. So I already talked about own nothing, control everything. So actually, one of the businesses I own with a business partner, when we're doing joint work, our business is once. Own nothing, control everything. Once business strategies. But when I'm working with my group of people and my clients, it's under Safe Money Solutions. Okay. Okay. Got it. All right, so this screen is a lot going on here, so I'm going to walk you through this. But this is our current business structure. This is how every business works that I have found. Okay, the revenue comes in. It comes into the LLC, LLP, S corp, C corp, however that business owner is structured. Okay. Yep. Then the expenses and deductions come out of that. The cost of goods sold, the payroll, the rent, the auto, whatever, the overhead. Okay. And then you kick out your income, the W-2, the 1099, or however, maybe a K-1. Okay. Yep. Before it goes anywhere else, you're going to pay taxes on that money. Okay. Yep. Up to 50% of that, depending on your tax bracket and depending on your state, you could pay up to 50% between federal and state taxes. And you see who's happy there? The tax man, Uncle Sam. Yeah. He's happy. Uncle. He's walking away with your piles of money, and instead you're getting pennies on the dollar. Yeah. Okay. And you're unhappy because you're trying to figure out how am I gonna keep going, right? Yeah. But the thing is, once we get that revenue and pay the taxes, now we can go buy the things that we want. But now we're paying for it after tax dollars, right? The food, fun, fashion. There's a reason why those three are highlighted in orange, and we're going to talk about that. Yeah. But food, fun, fashion. You're paying for your education or your kids' education. You're paying for homes. You're paying for cars, boats, travel, hobbies. Maybe you're buying businesses. Anything and everything is all after tax. Okay. Yep. Now we can go buy the things that we want to buy with pre-tax dollars. We buy the homes, we buy the cars. This trust can buy investments, after-tax investments. So the only thing that the trust cannot own are, what can't go in the trust are W-2 income directly, and it cannot own individual retirement accounts, qualified accounts, Roth IRAs, 401ks, all the numbers, retirement account type numbers, right? Those cannot go and be sold, go into the trust directly, and that. So that 5.5 becomes retained capital. So as long as that is held inside the corpus, remains tax deferred. Now, what makes the corpus is the plan, okay? What's unique with this trust is it's actually held inside of an escrow account, which gives us all these tax benefits, okay? So we can retain capital, family and lifestyle. We can do the things to purchase those things. So homes, cars, investments, insurance. For beneficiaries, it's the HEMS, health, education, maintenance, and support. Okay, so pretty much anything for the beneficiaries, you can pay for. Now the whole thing is you don't pay them, you don't give them the money, you pay the college directly. You give them an allowance, okay? Not cash, right? It might be money on a card or whatever. So, right? So, and that again, now here's the beautiful thing about this. This is going to be a lot of your business owners. There are certain things when it's inside this trust, it's not considered income by the IRS. This is the passive income features. Capital gains, think of brokerage accounts. Those brokerage accounts, they're going to gain, but this trust cannot, there's two things. This trust cannot be forced to pay any taxes out, okay?
That is really insightful.